Welcome back to the channel. Today we're going to be talking about the top 3 high-yield dividend stocks to buy now. So right now there's a lot of fear and uncertainty in the markets. So it's a great time to load up on dividend stocks especially. When I'm talking about a high-yield dividend stock, I'm talking about a dividend yield that's 4% or above. So the way I'm going to structure talking about these top 3 high-yield dividend stocks is first I'm going to talk about what the company is, what they do, any current news that the company might have, the financial strength of the company by looking at balance sheets and income statements, and lastly, I'm going to be going over the math behind the dividend yield for that particular stock. So just talking about how much you can potentially gain from owning a share of this company per year in dividends. And just tap that like button down in the corner and we'll go ahead and get started with number 1. And so the first stock I want to talk to you today about is UL or Unilever PLC. Now, you're probably not super familiar with that name, but I bet you are very familiar with the products and services they sell. So essentially this company focuses on consumer goods, specifically in the segments of beauty or personal care, food, and home care. So they have super strong brands like Axe body spray or Dove, like soap and all those things, Vaseline. In the food segment, they provide different types of ketchups, mayonnaise, and ice creams, and all other sorts of foods. So they have strong branding behind them. You've probably bought a bar of Dove soap at some point in your life, or something related to that. And if you're a guy, you probably purchased Axe body spray at some point just to impress the ladies at high school. So overall, they have big, strong brands behind the company. So as far as news goes, there's not anything crazy right now. They're working through supply chain issues because of COVID and all of that. However, Unilever does do a lot with Ben & Jerry's ice cream. And they're making a deal right now to get into Israel, so that is kind of big news, kind of opening up their market and being able to provide their goods and services to other places, which is going to increase revenue and hopefully increase profits overall. All right, so now let's look a little bit into the financial strength of the company by looking at their income statement and their balance sheet. All right, so if we go to the financials here of the company, and we're currently in the income statement, if we see here, they have a lot of revenue coming in. $52 billion of revenue in this last year, in 2021. And their operating income was $8.7 billion in 2021, which basically means that after the cost of goods sold or the cost to create and sell the product, their income is $8.7 billion. And then if you exclude all other expenses, we can see that their net income is close to $6 billion, which is incredible. So you're not going to be worried about this company paying out your dividends in the future. And with that kind of revenue and that kind of income, they have plenty of cash to reinvest into the company to make new products and to advance the products they currently have. So the outlook on this company would be looking pretty good. And if we're going to the balance sheet here, we can then see kind of how much cash they have here. So if we go to current assets, cash and cash equivalents, we can see here that they're sitting at about $2.5 billion of cash, which is a lot, and that's going to be able to pay off their dividends, so you're not going to get worried about them not paying you a dividend. Now, going into the math of the company, we can see that the stock price is currently $43.94. So if we go to a spreadsheet here, and we're just going to put down the ticker symbol, $43.93 to do some quick math, and it looks like their dividend yield is 4.39% annually. So 4.39%. And then we do some quick math here to determine that if we own one share of this company at $43, we can expect to make $1.93 every single year for doing absolutely nothing. And that is the beauty of dividends. Now, say you bought 2 shares, that's almost $4 a year for doing absolutely nothing. So the more shares you have, obviously, the more money you're going to be generating in dividends from that company every single year. All right, company number 2 we're going to be talking about is ticker symbol O, or Realty Income Corporation. And this company is basically structured as an REIT, or a REIT. And I think that's how you pronounce it. REIT? I think REIT sounds better. And a REIT is basically just a group of income generating real estate. And that real estate is generally commercial real estate. So like apartment buildings, office space, malls, real estate like that. And this company specifically focuses on industrial and retail centered real estate. And they have some really big top tenants such as 7-Eleven. So all those big gas stations you see those buildings are owned by this company, and 7-Eleven leases or rents those buildings, and that generates income for this company. And other big brands that lease real estate through this company are like Walgreens and even FedEx and just all sorts of big companies. So as far as current news goes, let's talk a little bit about inflation rates. Right now, inflation is super high, above 7%. So realty or real estate, realty income generally benefits from high inflation rates. And let me tell you why that is. So the number one reason is the value of the property is going to be increasing with higher inflations. Property values increasing because of inflation. Rent is also generally going to increase as well to combat inflation at these locations. So generally, this company or this realty corporation is going to be benefiting from these high inflation rates in the long term. So now let's look a little into their income and balance sheets and then go through the math behind the company. All right, so as we can see here, the current stock price is around $65. But going to the financials here, we're looking at close to a total revenue of $2.1 billion with a gross profit of $1.9 billion, which is pretty dang good. Now, if we're looking at their total net income, we're looking at $359 million. So there's a lot of expenses going in behind this company. However, they still have pretty sufficient cash in order to help pay out those dividends. But let's just double check here by going to the balance sheet. And we can see going into their current assets and their cash and cash equivalents, they have about $258 million in cash, which is more than enough to pay out these dividends that they're giving out quarterly or annually. So overall, the financial strength of this company isn't as great as Unilever, which was the previous company we talked about. Their operating expenses are a little high at nearly half of total revenue. So they have a lot of overhead, they have a lot to purchase. But then going back to the balance sheet, we can see that they have an insane amount of total assets. $43 billion in assets, which is from all of that real estate that they're purchasing. So based off their income statement and balance sheet, they're not overspending and buying more real estate than they can handle. And so going back, we're at a $65 stock price with a 4.3% dividend, which is more than the previous company. So going to do some math here, ticker symbol O here, $65 at a 4.43%. Some more simple math here. So we can expect $2.88 annually from owning one share of this company. So a little bit more expensive than Unilever, but you do get more of a dividend at a little bit of a higher percentage. But overall, a pretty solid dividend payout. All right, and that brings us to stock number 3 that we're going to be talking about, which is ticker symbol PRU, or Prudential Financial LLC. So essentially what this company does is they provide insurance, investment management, and other financial services. And they mostly deal with insurance. And now insurance benefits from rising interest rates, and it's theorized that interest rates are going to be increasing in the future. And let me explain to you why insurance benefits from rising interest rates. So the number one thing you need to understand is how insurance companies make their money. Now the way they make money is they take the premiums that people pay to have insurance and they invest it in things like bonds and stocks and other things like that to make a return. And generally bonds are really safe. And essentially when you're purchasing a bond, the company is giving money to the government in return for a return on their money in the future. So increased interest rates, especially with bonds, benefit the lenders, which in this case would be Prudential Financial Corporation. They're lending this money by purchasing bonds to the government. So they're going to be making more money, increasing revenues, the higher the interest rates are. So let's talk a little bit about how their income statement and balance sheet looks, so we can talk a little bit about the financial strength and then go over the numbers behind the dividend. All right, so going straight to the financials for this company, we're looking at crazy revenues at $70 billion per year. Now they have a lot of total expenses at $61 billion, but if we look at their overall net income, we're looking at $7.7 billion. So they're still making a lot of money. Even though they have very high expenses, their net income is still very desirable. So looking at their balance sheet, we're seeing insane assets. Almost $1 trillion worth of assets. And these assets are essentially the company's investments. So they have incredible financial strength looking at the income statement and balance sheet. They're bringing in a lot of money from their investments, and they're saving a good amount in net income, which can be used to reinvest into the company or pay those dividends steadily. So their current price is $103, and their dividend yield is 4.51%, the highest dividend yield we've seen so far. So we're looking at $103 at 4.51% for Prudential or PRU. And if we do some quick math once again, we're looking at $4.65 in dividends per year just owning this stock. So obviously comparing these companies solely based on a dividend payout, we're looking at PRU as paying out the highest dividend yield percentage, followed by O or Realty Corporation, then followed by Unilever or UL. And those are the top 3 high dividend yield stocks that I would recommend that are a great buy right now, especially in this market, especially in this bear market. It's a great idea to load up on stocks, dollar cost average into them, and make those dividends, which are considered to be recession proof. Now remember that I am not a financial advisor, so don't take this as financial advice or stock tips or stock picks or anything like that. And I repeat, it is not financial advice. But I hope you enjoyed this video. If you got any value out of this or learned anything, please smash the like button, subscribe, and have a great rest of your day.